$500 because you break it out at 50, tenfold is 500. Don't laugh. Okay. Now, I'm not saying we've got to go to 500, but I am saying everything else we see says this will be one dramatic and extremely fast. Is that just began? So people who are talking about, well, it's almost got to be over because it's vertical, silver, gold, vertical.
Yeah.
On arithmetic charts it is. But they're wrong. The game really just began where the real water flow into the monetary metals has only just been signaled. Let's say 300. I bet it overshoots it by a couple hundred in a tantrum. So that's why you can be a bit outrageous here. Now, anyway, at this phase, once you get that jiggle especially, it's going to be a large multiple gain from here. So you don't need the leverage. Catching it in the first part, good idea. Got a lot of cash now. You caught that first move with some leverage or calls. That's great. Super.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The recent price action in the precious metals, especially silver, has been nothing short of astounding. But they're no surprise to today's guest, who boldly predicted this violent upside breakout. Our questions are now flying fast and furious. How much farther are prices likely to rise? Is a vicious pullback likely soon, similar to what the metals experienced after the spike seen in both 1980 and 2011? And if so, should I start selling? Why haven't the mining stocks performed as well as expected? To address these pressing questions, we're fortunate to welcome back to the program technical analyst and author Michael Oliver, founder of market research firm Momentum Structural Analysis. Michael, thanks so much for joining us today.
And good to be back, very much.
Well, thank you so much, Michael, and I very much appreciate you making the time to come talk to the Thoughtful Money audience here at a time where you're the man who called it all. So I'm sure your phone is ringing off the hook. I'm sure you've got a lot of analysis to be doing as things are continuing to unfold here in real time. But again, very much appreciate you making the time for us.
Thank you.
All right. So first off, let me just start with a massive congrats to you. You are a technical analyst. So basically you say what your charts are telling you, but your charts were telling you something extraordinary about the precious metals last time we talked. You do a lot of, oh gosh, I forget what you call it, but sort of ratio charts.
Yeah, the spread charts.
Spread charts, yeah. And you were looking at charts of gold to the S&P and silver to the S&P. And I think when we talked, gold had just made a breakout and silver was just about to. And if you said if silver breaks through that, both of those things looked like they were going to catapult higher. And you were putting some price targets out there that were pretty darn aggressive. And they have been hit in a very short period of time. So congratulations. That's a real validation of your methodology.
Thank you. But those targets are minimal and we're going a lot higher.
We're going a lot higher. Okay. So why don't we let's get into any and all of this. So first question, which I think we probably know the answer to, but I'm going to ask it anyways. Is the breakout that we've seen in the precious metals over the past 2 months, since your spread chart breakouts, the actual breakouts, is that all performing as you expected here?
Yes, it is. Those spread relationships, meaning it's a relative valuation chart of the ounce of gold divided into the S&P 500 price. And we went back to 2013 and on that chart, and you could see that basically over the last 11 years, gold has wandered sideways in value to the S&P, ups and downs, but basically contained. So you could call it a par performer. Meaning, it depends on when you bought gold, you're doing better than the S&P, sometimes worse, but basically sideways in performance over the 11 years, which very few investors had acknowledged, but it was a fact. Anyway, that chart had a very clear ceiling on it. And you could draw for like 4 pivotal highs that bumped this line, okay? And late last year, they closed above it. Monthly closing was October, November. And since then, what happened is gold has surged in relative performance to the S&P, well up out of that base. But the net price of gold has also gone quite vertical. Okay. Same thing happened with silver shortly. I think it was the same month, actually, where it had a basing type relative performance to the S&P. a little bit more declining than gold had been over the last 11 years in terms of its valuation to the S&P. And it broke out and it exploded. Okay. So the spread chart was a technical metric above and beyond our normal analysis. Normally, what we're looking at is the momentum of price,
Mm-hmm.
where we plot a price chart on the top where that's what everybody sees on their screen, and below it we plot a momentum oscillator, which takes that price chart and oscillates it versus certain moving averages, and in this case, long-term averages. And that's already been in a bull market. We know, silver and gold been going up for quite a while. So the issue is, well, why did they suddenly go berserk?
The spread chart methodology is the analytical foundation for everything Michael Oliver says in this interview, and it is almost entirely invisible to retail investors who only look at absolute price charts. When gold is measured not in dollars but in S&P 500 units, a completely different picture emerges. For 11 years, from 2013 to late 2024, gold was essentially treading water relative to the stock market. Not losing, not winning. Sideways. Then it broke above a ceiling defined by 4 separate highs spanning 11 years. That kind of breakout, confirmed on a monthly close, not just an intraday spike, is the signature of a structural shift, not a momentum trade. The silver breakout was even more dramatic because silver had actually been declining relative to the S&P over that period. When silver broke out of a downtrend in relative valuation terms, it didn't just break even, it reversed and exploded.
Well, the reason was that signal occurred and indicating an asset class flow out of the stock market and into them. Now, you haven't seen the stock market weaken yet. It's just sort of fumbled around for about 6 months, really. But
Right.
you've seen some kind of money flow suddenly said, okay, we're moving out of this neutral pattern. We're going into monetary metals. So somebody's waking up. And
Yeah.
that caused that push effect.
Okay, and that was the next question I was going to ask you, which is, what do you think? I mean, you spend a lot of time looking at the charts and looking at price
Yeah,
action,
yeah.
but in terms of the actual drivers of the price action, um, you said, okay, somebody's saying I want to get into monetary metals.
Mhm.
I mean, how much time do you spend thinking about the macro? And when it comes to
Oh,
gold,
oh, yeah, definitely. We've been bullish on gold since February of 2016, when gold came up off its December 2015 low at
Mhm.
1,050. At 1140, we said, okay, major upturn. We'd been bearish from 2012 through 15, by the way. But we had annual momentum breakout. And when you looked at a price chart back then, you just another staircase low, and you barely turned up off of it. But when you looked at momentum, you saw something different. Anyway, but the point is that long-term metric of measuring the trend direction of gold, for example, or silver, has not broken down since then. It's continued to rise in layers, but nothing technically has indicated that bull trend that began 10 years ago
Mhm.
is over. And then now you're reaching the phase, though, in the bull trend where you're no longer doing the arm wrestling layered advance, which has, bored the heck out of gold investors for the last 10 years and frustrated silver investors, because you go up and then you have this 1 year wide range, and then you go up again and you have a correction, and it's arduous. We reached the point late last year when the relative performance of monetary metals versus the US stock market said no more. We're now going to leave the earth compared to you. We're leaving you behind. And that's the point at which it's indicating at least an initial shift by normal portfolio managers, fund managers, that are saying, hey, Morgan Stanley said 60-40 is no longer good. It's now 60%, 20% bonds, 20% gold.
Mhm.
And that was a huge intellectual admission on their part that the old reality was wrong. Okay. And that UST bonds are not, the other alternative, that the stock market instead gold is. I disagree with their weighting, but at least it was an admission. Well, some money has started to flow and you can measure it. You can see it.
Okay, wait, I got to interrupt though. So
Go
what
ahead.
do you think the weighting should be? Higher?
Oh, it probably should be 80, 10, 10. Okay, gold. Okay. No, there's times when gold should be at the front. Okay. And we're at that point now where it's outperforming even the bubble US stock market, which is one of the strongest stock markets since 2009. US stock market's been among the strongest. China is not a bubble. It's only about double where it was in 2009, but we've gone up. S&P's gone up 11, 12 fold. NASDAQ 100 has gone up 20 plus fold since 2009. So measuring gold against them it's a harsh measure because it's a strong market, strong stock market, and yet it's beating it, indicating somebody punched a hole in that dam and the water's starting to flow out. And it's
Okay.
going into money. Okay, so that's just begun though. That's the point. Is that just began? So people who are talking about, well, it's almost got to be over because it's vertical, silver, gold, vertical.
Yeah.
On arithmetic charts it is. But they're wrong. The game really just began where the real water flow into the monetary metals has only just been signaled. So the more accelerated price phase where that money flows into what really is a fairly small sector, especially the gold and silver miners.
The 10-year context is critical to understanding why Michael Oliver is so confident this move has much further to go. He has been bullish on gold since 2016, 9 years ago, and he has watched it grind upward in the frustrating layered advance he describes. The breakout in late 2024 is not the start of a bull market. It is the acceleration phase of a bull market that is already nearly a decade old. The Morgan Stanley 60-20-20 allocation change is the institutional admission that the old framework was wrong. When the world's largest wealth manager publicly changes its model allocation to include 20% gold for the first time in decades, it signals the very beginning of a multi-trillion-dollar reallocation. That reallocation hasn't happened yet. The money is still in stocks and bonds. The water has just started coming through the hole in the dam.
Right. Tiny. Yeah.
There could be, a huge impact on the verticality of those markets.
Okay. So let me ask you this then, and I'm going to ask you your price targets in just a second. There are longtime veteran precious metals investors. Rick Rule is one who comes to mind, who is saying, look, I'm still bullish on the metals and the miners, all that stuff, but I've been around this enough of these cycles to know that when the price goes vertical, it can't go vertical forever, and that typically is followed by some sort of material pullback. So my point is my question to you is, can you and Rick both be right in the sense that could there be a short-term, material pullback in prices because they've run so far so fast, but then after finding their footing again, have a secular rise to, much higher highs for the macro reasons you're talking about?
Here's our assessment on that. One, this is not a normal bull market. So using old standards of verticality and saying, well, in 1980, we had this huge surge in the tail end of that move. In the last 5 months of that move, in fact, silver quadrupled. 5 months.
Yeah.
And already an aged bull trend. And in 2011, after going up for 10 years, silver in the last 7 months jumped from 20 to 50, double and a half. All of a sudden, boom, boom, faster than it ever had a pace during the entire bull market.
Mm-hmm.
This is different, not simply because silver broke out above what I call idiot highs, the old $50 high of the half century. It's because of other technical factors that we're looking at, and there's clear monetary factors underneath this stuff that are only just now engaging, like the dollar index, for example, which we got bearish a year ago at 104. It's now trading about 96. It's a modest drop. But we broke all the annual momentum uptrends of the dollar index going back to 2010.
Okay.
Price chart stopped on a trend line that any idiot with a ruler and a crayon could see, and they've been buying it there for 9 months. Now you're breaking below it. So that game is just beginning. In other words, a sharply weak dollar.
Yeah.
T-bonds are in dire straits. They're dancing on glass. The Fed is buying them, but they're not going up. That's another market that could, with a rough ballpark number, you drop 2 to 3 more points in the T-bond futures, and they're trading around just below 115 right now. 30-year bond futures. You drop down in much under 113, like in the 112s and 111s, you could have a panic in government debt, not in mortgages, but in government debt. Japan has already got it. If we start to show it, that rips everything apart in terms of stability assumptions, asset categories.
Yeah,
And at that
I
point,
agree. If we
yep.
had a loss of confidence in the U.S.
Well,
Treasury
I think
debt.
you're going to get it. And the question is it right now or is it in a month or two? And I could go for the month or two. I think you're going to get that downside. And in the T-bonds, which
Mhm.
will upset the world and upset the stock market at that point. Right now, the T-bonds are so comatose. Well, the president of the Fed, New York Fed, Williams, short about the time we had our last talk,
Mhm.
made a press conference in November that said that the Fed is now going to, quote, start buying bonds. Okay. Ooh, okay. His reason was not to support the market, but to provide liquidity.
Right,
That's
right.
cute.
Don't call it QE, even though it is
Oh no,
QE.
don't call it anything, and nothing's no fire here to put out or anything like that. But they've been buying since then, and that bond market has oozed lower and lower, and you can tell it's being supported because, like the last 2 months in T-bonds, and this is important because it'll impact gold and silver.
Mhm.
They've been in the most narrow price range in T-bonds where they can't seem to go any lower, but they can't seem to rally either. It's
Mhm.
like a point and a half range in T-bonds, not
Yeah,
yield,
they
price.
can't get the yields below 4.
I've
Yeah.
never seen the bond markets in decades have a narrow range that protracted, that narrow, going back years where it's behaved like that. So it's evident that they are in fact buying and supporting that market,
Yeah.
but it's not causing it to go up or yields to drop. That's a problem.
The 1980 and 2011 analogies are the biggest intellectual trap for precious metals investors right now, and Michael Oliver dismantles them with surgical precision. Both 1980 and 2011 were the final vertical phases of aged bull markets that were already running on fumes. This bull market is different in a fundamental way. The structural factors underneath it, the dollar breakdown, the bond market fragility, the institutional reallocation just beginning, are not resolving. They are intensifying. The dollar chart breaking all annual momentum uptrends going back to 2010 is not a correction in a dollar bull market. It is the end of the dollar bull market. And the T-bond situation is the most alarming data point Michael raises. The Fed is openly buying bonds, and the market is still declining. When the central bank is transparently supporting a market, and the market still can't rally, you are watching a structural problem that no amount of money printing resolves cleanly.
And that could just begin, meaning if it doesn't succeed in holding it and we slip a couple more points, our technicals say you could get a downside panic in price, upside in
Okay.
yields.
And sorry to interject, but so let's say that happens, right?
Yeah,
Bad
yeah,
for bonds, bad for stocks, because the stock market's going to
correct.
freak out
Yeah.
about
Yeah.
credit confidence issues. I can see why that would be really good for gold, but I wonder, like we've seen in kind of past panics, um, if the stock market goes down and if the bond market goes down at the same time, people start getting margin calls. So might you expect a dynamic where it actually hurts the precious metals before they go off to the races again?
Or they could be off to the races before that happens. Our assessment of this move in silver in particular is that it's going to a new reality. I can give you umpteen long-term verbal reasons why,
Okay.
charts included. I think silver's going into several $100s, may even go as
Okay.
high as 500, and I think it will do it by summer this year. These accelerated moves in silver, even the ones that occurred in that compressed 50-year, half-century antiquity range that surged up to $50, they occurred in a couple quarters where silver went ballistic and reached the top of that range. We're no longer dealing with that range anymore. But some of the same technical metrics that signaled the onset of those orgies on the upside in silver, where it had already been going up for years and suddenly goes berserk. was a spread relationship between silver and gold. Silver is still vastly undervalued to gold. If you go back 50 years and look at the surges in price that occurred in silver, like 79 to 80, look what the spread of silver versus gold was then. In other words, divide an ounce of silver into an ounce of gold. Back then it was 6.5%. Okay, keep that in mind. Then in the 2010-11 final 7-month surge of that multi-year bull market, silver broke out versus gold on a spread chart now. You didn't see it looking at the price chart. Price was going up, both of them going up merrily, but that spread broke out and that announced verticality for silver that lasted a couple of quarters, just like the other one, 79 to 80. Silver went up double and a half in 7 months, but it was still confined in that 50-year range, which was sort of silly given the degradation in the money unit. If you factored where silver ought to be now versus 1980 high at 50, it probably should be $500. In fact, I think that's about right. And if you measured it against the 2011 peak when silver was 50, in that surge, again in the box, its spread was 3.1. Right now, silver is only 2.1% of the price of gold, so it's still cheap historically. We're arguing that not only has silver broken out of its range and likely to have an orgy on the upside that mostly gets done within a couple quarters, counting again from the November close last year. So December, January, we're only 2 months into this couple month thesis. That the spread might just do what price did, namely take out the highs of the last 50 years. $50 silver, $50 silver, that's gone. Okay, fast. Why not challenge the relative performance highs because silver is still cheap? Why not challenge 3%? Why not challenge 6.5%? Price took out those highs. Silver's still cheap. Maybe its spread will also reach those levels. You do the math on what silver, if continue gold up, what silver might be at 3% or 6% of an ongoing bull trend in gold. It takes you off the page.
Wow.
Another metric here. Now, pardon me for going too long here.
No, it's all good. It's all great.
If you look at an idiot price chart, arithmetic scale, go back to 75. You've got that range that was like from $4 lows to $50 highs. So, call it a $50 range or a $45 range. And if you see a price range like that and you break out, the orthodoxy of price analysis is to, take the thickness of the range and add it to the range. That's your swing objective. Well, we reached that about a week or so ago when we were in the 90s, mid-90s, 95 area. That matched the swing objective of the dimension of that range. And you found there was a lot of selling there. I don't know if you remember what it was. We had some pretty sharp hourly sell-offs in that range. We finally blew those guys out. So it's no longer an issue of, double the range. When you look at silver on a ratio scale chart, logarithmic, same period of time, go back to 75. The bottom of that range was $4 and you go to 50. Okay, well, that's like a 10-fold move plus. So a geometrically or logarithmic scale, ratio scale. How much did silver go up? 10-fold from the bottom of the range to the top. You broke out of the range. The logarithmic swing objective of that same range on a ratio scale chart is $500. Because you break it out at 50, 10-fold is 500. Don't laugh. Okay. Now, I'm not saying we've got to go to 500, but I am saying everything else we see says this will be one dramatic and extremely fast. And yes, the worry about a correction in the middle, that's highly likely. And what we're doing at MSA right now is trying to deal with that issue for our subscribers so that if they are itchy, or let's say they've got leverage positions and they've got call options, things that, they don't particularly want to have to suffer through a correction with. We're going to try to measure when and where that occurs. Our suspicion right now is one, the factors that would define that. And by the way, corrections like this did occur in that 79 to 80 surge where silver quadrupled in 5 months and doubled in half between September 2010 and April 2011 on the way to $50. There was a correction in each of those right in the middle of that clock like a month 3, let's say, uh, either side of that, where you had what you could call a correction. It was only 15% in each case, by the way. But
Okay.
it was enough to cause people to think, that's the top. What
Hmm.
happened on the other side of that was even more than what had happened in the first half of that couple quarter move.
Right.
So it's going to be interesting. I suspect you're going to get a trading type wiggle that all the doubters and the people using old metrics will say, there we go. We're going to have a major correction. You're not. I think you're going to have a wiggle, something that interrupts it for like a month. And then when you come out of that, that's when you get the next burst.
The logarithmic swing objective methodology is the most technically rigorous argument for a $500 silver price target that exists anywhere in the public discourse. This is not price forecasting by extrapolation or by gut feel. It is a formal application of ratio scale technical analysis that has been the standard in professional charting since the mid-20th century. The reasoning is as follows. Silver spent 50 years building a range from $4 to $50, a tenfold move. When a price breaks out of a long-term range, the swing objective on a logarithmic scale is equivalent to another move of the same magnitude from the breakout point. 10's $50 equals $500. This is the same methodology that would have produced a $500 target at the $50 breakout in any prior cycle. Except prior cycles never broke out of the $50 range. This one did. The silver to gold spread analysis adds independent confirmation. At the 1980 peak, silver was 6.5% of the gold price. At the 2011 peak, it was 3.1%. Today it is 2.1%. Silver has more relative room to run than at either prior peak, while also having broken above the absolute price ceiling that contained both of those peaks.
That's our assessment.
Okay. Look, thank you for being so detailed there. I'm still kind of in shell shock from just the number of $500 an ounce silver. But man, from your lips to God's ears, buddy. Let's hope that that happens. So here's what I kind of take from what you just said, and you tell me if I'm capturing it correctly. You think silver has this tremendous amount of potential energy still to be unleashed
Yes.
going forward. You're totally open to the fact that there could be some corrections along the way, even though you expect this rocket ride to arrive relatively soon, like in the next 2 quarters by summerish, you
Yes, so
said,
by
right?
summertime, I expect this to be largely June, July, August. Somewhere in there, I expect it to be the large part of the move to be totally accomplished.
To be total, yeah. So, from one point of view, and I'm guessing this is sort of yours. So not, we're not talking about your subscribers right now who tend to be,
Mhm.
more active. I won't use the professional, but I'm sure you have a lot of professional investors there. But
Yeah.
people who are more sophisticated, right? My guess is you would say to the average person who is a silver investor, especially if they own physical ounces that are a little bit harder to trade in and trade out,
Mhm.
just say, don't worry about it. Just
Yep.
sit tight. If there's a pullback, just don't sweat it. Just don't look at the
Yeah.
tape for a while, and you'll be taken care of by the time
Mhm.
summer comes around. Is that more or less accurate?
Yes, that's it, dead right. In other
Okay.
words, we're going to caution heavily when we get to the point where we think there's a correction. And I suspect if there's going to be one roughly midpoint on the clock, it's going to be late February, early March, probably at much, much higher prices for silver and for gold, but just it'll be lagged to silver. Okay. Uh, so I think there will be one, let's call it a month from now. Okay. And when
Hmm.
that occurs, we're going to caution people that if you're not leveraged and if you're invested in, just outright ownership of miners, which I think is a place to emphasize right now,
Hmm.
or silver, but it's unleveraged. If you choose not to flinch during the correction, that's fine. Because the real problem with each of the corrections we've seen in this lethargic advance in silver has been that when it turns up, you don't get a chance. If you don't really astute, you miss getting back in because
Right.
suddenly whap, you're back to the highs.
Right.
So one, it's important to get out right, and two, to get back in right. So it's really tricky because these corrections, if you go back and look at the archive, the action in 79 to 80 and to 10 to 11, boy, it was tough to get back in because when it turned, it just boom.
Right. It
What? Yeah. Yeah.
moves before you can react, and
So it's a
then
real risk if you
yeah.
do get out during that correction, unless you've got, again, we're going to suggest to people, and I'm doing this with my own portfolio, move out of the leverage stuff and just go into 100% bullion equivalents or ETFs that hold bullion.
This is the most practically important advice in the entire interview for the average silver investor who owns physical ounces. The 15% mid-cycle correction that Michael expects in late February or early March will feel psychologically identical to the crashes that ended the 1980 and 2011 bull markets. Same velocity, same fear. But in both prior cases, the second half of the move was bigger than the first. If you sell into a 15% correction expecting a 50% crash and instead watch silver blast to new highs within a month, you will not get back in. Human psychology guarantees this. The solution is exactly what Michael prescribes. If you are unleveraged in physical metal or miners, do nothing. The volatility is the tax you pay for the compounding gains on the other side.
Or miners.
And the miners. Okay.
Yeah.
And we're going to talk about the miners in just a
Yeah.
second. Um, okay. So again, to reiterate, you think there's going to be a massive move between now and the summer. Probably quite likely there's a correction there. The key thing is don't get shaken out. To your point, maybe get out of your leverage stuff, get into the real things, the metals themselves or the miners. And so I'm harping on this only because I've been getting this question. I mean, right now, just my X feed, and I was at a conference, and just people in general are saying, "Hey, what do I do? I've had these amazing gains. I'm looking at the price action. I know vertical moves don't last forever. I don't want to necessarily watch my gains vaporize, the way that they did back in 2011 or 1980."
When it was range bound. Yeah.
When it
Yeah.
was range, and you've
Yeah.
explained sort of why it's going to be different this time than back then. I am doing two things, which is encouraging people to emotionally prepare for a pullback, just as you are, and encouraging them to basically just what can you live with, right? And I mean, I'm still bullish of their long-term potential of the metals. This was before you and I had talked today, and the number of $500 an ounce silver came up. So you're even more so than I've been. So I'm just encouraging people to think about what makes sense to them. If you get a 20-year horizon, yeah, ride the downtime. Don't worry about it, right? If you need this money, in 3 months, well, then yeah, maybe you want to take some off the table or whatever. I personally have been playing this, and this is not personal financial advice, but it's been more with hedges, which is, I'm not selling my ounces that I have. I don't want to play the game of trying to get in or trying to get back out. I'm sure I'll mistime that. So for me, I'm just sort of buying more like, downside protection in the near term, right? And I would love it if these hedges expire worthless because it means that the metal's doing well. How do you think about that strategy?
Yes, I agree. But remember, and this is something I've thought about myself and in part of the subscribers. When you get out of this trade, and this is not a trade, by the way, we're looking at money going up. This is not
Hmm.
some metals. This is thousands of year old money. Okay.
Right. Which
But
is
the
why I
other,
don't want to sell my ounces.
well,
I feel
yeah,
like that.
if you want to go to cash at the end of this, do that. But that cash is called gold or silver.
Right.
Okay. You want to go to a dollar, it's backed by nothing, just like the yen, just like the euro. They're evaporating in value decade by decade. You go look at an M2 chart and smack yourself in the face with some cold water when you look at it.
Hmm.
Every decade, it increases in quantity by about 80 to 90%, meaning it degrades by that much in terms of,
Yes.
when
Purchasing power.
yeah, when your dad built a house, it was 45,000. When your granddad, it was 4,500. And you want to build a new median house, it's 450,000. The degradation of money. So to put it into quote cash is a ludicrous statement. That's like saying, I'm going to buy the dollar and watch it drop in value.
Yeah.
Okay. So put it in bullion, which you should already be in now anyway at this phase, once you get that jiggle, especially. It's going to be a large multiple gain from here. So you don't need the leverage. Catching it in the first part, good idea. Got a lot of cash now. You caught that first move with some leverage or calls. That's great, super. You can go to the bullion now and relax and breathe calmly.
Michael Oliver's reframing of gold and silver, not as commodities but as money, thousands of year old money, is the philosophical bedrock of his entire price thesis. When he says silver is going to $500, he is not saying some commodity is getting expensive. He is saying the purchasing power of the dollar is collapsing toward its intrinsic value, and gold and silver are simply reflecting that collapse in nominal terms. The M2 observation is devastating in its simplicity. The U.S. money supply increases roughly 80 to 90% every decade. That means a dollar loses roughly half its purchasing power per decade in terms of what it can buy relative to money supply adjusted prices. The house price example, $4,500 to $45,000 to $450,000, is the lived experience of 3 generations watching their fiat currency evaporate. Selling gold and silver for dollars at the end of this move is, as Michael says, ludicrous. You would be trading thousands of year-old money for a piece of paper that has no intrinsic backing and loses 80 to 90% of its purchasing power every 10 years.
But I think on the other side of this, there's going to be a new world. And I think silver's going to a new reality, meaning gold's gone to a new reality for 50 years. Look at the 80 peak, then look at the 2011 peak, and look where we are now. Those were 8-fold moves, each of those bulls. We're only 5-fold right now from our bear low. So if we go to 8-fold, gold to be 8,500, merely matching its prior 2 highs in terms of multiple gain. Silver was confined in a 50-year range all during that time. Why? Gold wasn't. Heck, copper wasn't.
Yeah. A lot of people think intentional suppression. Are you in that camp?
I think it's quite valid or whatever. But when the market makes mistakes, and you know this being involved with the markets, whether it makes a mistake of being excessively overpriced, let's say the dot-com top, when it corrects, it overcorrects.
Right.
It has a tantrum the other way. So when the S&P went down from 2000 to 2002 in that bear market, the dot-com breaking bubble dropped 50%. NASDAQ dropped 82%, almost wiped itself out. It's overcorrected for the dot-com. And we've got anyway, silver has been the opposite. It's been underpriced relative to anything you want to measure, to gold, to the S&P 500. It's now just freshly broken out versus those other assets, versus gold, versus the S&P. So this is really something that just began in a big way, an asset clash. Silver's going to seek a new reality. And if that should logically be monetary factors factored in, let's say 300, I bet it overshoots it by a couple hundred.
Right.
In a tantrum. So that's why you can be a bit outrageous here and make such.
And I'll give you a chance to come back on in the future and update us on this.
Okay.
But given that, I mean, it makes me think that maybe when silver hits $500, you might tell people, hey, prepare for it to now go down.
Correct, back to 300 or something.
Exactly.
Not back to 50. Okay, that reality is going to be left behind.
Right. The 50 is, but 300 might be the new.
Yeah, maybe the new reality should be logically and again, monetary factors out, the money supply growth, where should silver be? It might be 300 or something. So whatever it might be, I bet you overshoot it. And then you go back and live in the new reality. Okay.
Yeah. So I think one of the things you're saying that silver has more than almost anything else here is, it's got true price discovery going behind it. And this analogy has been used around gold, but I think you're saying it's much more, it's even more relevant with silver, which is the beach ball that's been held underwater.
Yes.
Right? It's been held underwater. Finally, it's escaped the hands that were suppressing it. It's now shooting higher. And, just like a beach ball that's held underwater, it'll burst above the waves.
Yes.
And that'll be the overcorrection. Then it'll come back down to the water line, right?
That's a good analogy. I think that's what's underway. I think it'll be quick. And then the issue you mentioned a while ago that I didn't address, stock market weakness. Right now, we think the stock market is topping. Last 3 months, we've been arguing it's got to continue up, though, get above 7,000, which it did today, but probably even more. Probably at least get into February before it decides to roll over again. But we think it's a broad topping process of major proportions. It is going into a massive bear market when asset class breakage occurs, like in the T-bond market, the dollar stock market bubble breaks. But I don't see crash-like event based on technicals, which usually
Okay.
will warn you, oh gosh, you're breaking something big on
Yeah.
on the momentum. Then you know, oh, there it collapses.
Yeah.
Momentum usually, we do have those structures in the S&P below, but they're far below.
The beach ball analogy is the most intuitive and visually powerful explanation of silver's current situation. A beach ball held underwater is not in equilibrium. It is in forced disequilibrium, maintained by energy input from whoever is holding it down. The moment that force is removed or overwhelmed, the ball does not float to the surface at a leisurely pace. It erupts. The depth to which it was submerged determines the height above the waterline it will reach before gravity pulls it back. Silver has been held under for 50 years, the deepest, longest held down beach ball in modern market history. The overshooting logic is mathematically sound. When a market corrects an extreme undervaluation, it does not stop at fair value. It overcorrects to the same degree that it was previously undercorrected. $300 is the logical fair value. $500 is the overshoot. $300 is the new floor.
Requires getting down around 5,400 anytime this year. Well, heck, we're 7,000. So any break we have between now and then could be arduous, slow, slabs,
Sorry
not
to
a
jump,
panic.
yeah,
No.
but so kind of like 2022 is sort of what you're saying, where it was just a slow
Yeah,
grind
yeah.
down for
Yeah,
most of the
or
year.
2007 to 9. There was a crash event in the S&P, but when did it occur? A full year off the high. You made a
Right,
high in October 2007. You didn't have your puke event where you dropped like 30% in a month, okay,
right,
in weeks.
but it was
Yeah.
grinding down towards that puke
Yeah,
event,
it was
right? Yeah,
grinding, but it wasn't dramatic. In fact, it was
yeah,
still, most people were debating, is it really going down? We weren't, but I mean, most people were saying, because you'd have rallies that would impress. And I
right.
think we're in that position where, yes, you could top the stock market. But again, think about that. Let's say the stock market peaks next month, a couple hundred points above here in the S&P. And then you
Yep.
start to roll over, but it doesn't crash. It's arm wrestling. And, but at that point, you know, once you get out to April, May, and then you get into June, and only then is the stock market maybe even approaching the really danger levels where you could get speed. Where might the metals already be by then? Where might the miners already be by then?
The stock market call is the macro context that makes the metals thesis even more powerful. A grinding bear market, not a crash, is actually the most dangerous scenario for investors because it creates continuous uncertainty without the cathartic bottom that a crash provides. In 2022, investors spent the entire year watching a slow-motion portfolio destruction while central banks raised rates. In 2007-2008, the market ground down for a full year before the October 2008 collapse. What Michael is describing is the same pattern, a slow grind from around 7,000 that doesn't become a panic until the S&P approaches 5,400 sometime in 2026. The critical timing insight: if the metals are going to summer highs while the stock market is only beginning to grind lower, the divergence between gold-silver performance and S&P performance will be one of the most dramatic in market history.